How Three Arrows Capital lost $10 billion, a crypto collapse explained. It's October 2022. The global financial world is still reeling from a string of shocks. The collapse of the Terra USD stablecoin, Silicon Valley Bank's stunning failure, and a bear market relentlessly driving crypto valuations into the red. And in this maelstrom of financial turmoil, one name surfaces, emblematic of both the meteoric rise and devastating fall of crypto hedge funds. Three Arrows Capital. Founded in 2012, this once mighty hedge fund, managing close to $10 billion at its peak, implodes spectacularly, shaking the crypto markets to their core. But why should the collapse of a hedge fund make waves outside Silicon Valley or Wall Street? Because Three Arrows Capital, or 3AC, was more than just another hedge fund. It was a titan of crypto finance whose strategies and failures exposed vulnerabilities in a market still seeking legitimacy. Its downfall wiped out institutional investors, retail holders, and entire platforms, illustrating how the frenzied innovation of crypto trading runs on precarious foundations. Understanding the mechanics behind 3AC's rise and collapse reveals a cautionary tale about leverage, risk management, and the fragile interconnectedness of the crypto ecosystem, a story whose repercussions are still shaping market behavior in 2024. To grasp 3AC's story, we need to understand what the firm was, how it operated, and why its strategy ultimately collapsed so catastrophically. At its core, Three Arrows Capital was a crypto-focused investment firm and hedge fund, founded and led by Daniel Dan Hua and Kyle Davies, both Harvard graduates. From early on, their vision was to treat cryptocurrencies as a new asset class. But unlike typical venture capital approaches that focused on long-term bets, 3AC was aggressive, heavily leveraging its positions and using complex derivatives to amplify gains. The fund raised billions in capital, reportedly managing assets peaking around $10 billion, although exact figures have been fluid due to volatile crypto valuations. Unlike traditional hedge funds, which primarily invest in stocks, bonds, or currencies, 3AC positioned itself deeply in the crypto universe, including Bitcoin, Ethereum, DeFi projects, NFTs, and crypto protocols at every stage. But rather than coldly picking undervalued tokens or spreading its bets conservatively, the fund routinely took outsized, highly leveraged positions based on bullish assumptions, using borrowed funds and derivatives to multiply exposure by factors of 5 or more. It was this reliance on leverage, borrowing money to amplify returns, that sowed the seeds of disaster. Leverage can magnify profits in a rising market, but it also deepens losses catastrophically when prices reverse. In early 2021 and into 2022, the crypto boom was booming. Bitcoin jumped from $30,000 in January 2021 to nearly $69,000 in November 2021, along with explosive growth in altcoins and DeFi tokens. At the same time, 3AC went all in, deploying massive amounts of capital across the board. According to Bloomberg, by mid-2022, 3A's positions included huge stakes in Ether, Solana, Avalanche, Luna, and other major tokens, often acquired via highly leveraged loans from crypto lenders like Genesis Trading and Voyager Digital. However, the first cracks began showing in May 2022 when a major blow to the crypto ecosystem hit: the collapse of Terra USD, UST, an algorithmic stablecoin designed to maintain parity with the US dollar. Terra's attempt to maintain this peg failed catastrophically, sending the token into a downward spiral that wiped $60 billion from the crypto market in just days. And 3AC was heavily exposed to Terra and its sister coin, Luna. This event was a critical turning point. It spiked market volatility as crypto prices plummeted, particularly for speculative altcoins and projects tied to DeFi platforms. 3AC's highly leveraged bets became vulnerable. Asset values dropped faster than levels that could sustain margin requirements on borrowed capital. Loans became under-collateralized, forcing lenders to demand repayment or liquidate collateral. By June and July 2022, the situation worsened. Crypto prices continued falling. Bitcoin dropped below $20,000 for the first time since late 2020, and the dominoes started to fall. The hedge fund Genesis Trading filed for bankruptcy in January 2023, heavily impacted by defaults from clients including 3AC. Voyager Digital also filed for Chapter 11 bankruptcy in July 2022, citing massive exposure to 3AC loans as a key factor. 3AC tried to stabilize through a massive recapitalization effort, meant to raise funds from investors to meet margin calls and repay lenders. But it was too little too late. According to court documents filed in the British Virgin Islands, where 3AC was incorporated, the fund had liabilities ranging up to $3.5 billion and was unable to meet obligations. On July 1, 2022, Three Arrows Capital officially filed for Chapter 15 bankruptcy protection in the U.S., signifying its cross-border insolvency issues. This bankruptcy revealed the full extent of over-leveraging. Estimates at the time pointed to 3AC owing billions to crypto lenders. The trust that had allowed the fund to borrow at large scale evaporated instantly. But what does this mean practically for the markets and investors? The collapse of 3AC triggered a tightening of lending standards across crypto lenders, much like after the 2008 financial crisis's knock-on effects for shadow banks. Firms like Celsius, BlockFi, Nexo, and others began imposing stricter collateral requirements and reducing leverage availability. The cascading failures forced many retail investors to face margin calls or see their holdings liquidated, while institutional players reassessed the risk profiles of crypto assets and counterparty risk. Moreover, 3AC's downfall forced liquidators to attempt selling off frozen assets. CoinDesk reported that liquidators were planning to sell off tens of millions in NFTs and stakes in projects like ApeCoin to recover creditor funds. The fund held stakes in roughly 30 blockchain-based companies with varying degrees of ownership, indicating the interwoven network of exposures across the sector. From a regulatory perspective, 3AC's implosion underscored the dangers of unregulated leverage in crypto finance. Unlike traditional banks or hedge funds registered with oversight bodies like the SEC or FCA, 3AC operated in a largely unregulated environment. The opacity and speed of its trades and the lack of mandated risk disclosures meant creditors often didn't have full transparency into 3AC's risk profile until it collapsed. This has fueled calls for clearer regulations on crypto lending, leverage limits, and disclosure requirements. Another dimension is geopolitical. 3AC was co-founded by Singapore-based nationals and registered offshore in the British Virgin Islands, which complicated cross-border legal proceedings. The company's founders faced asset seizures. Reports from early 2023 indicated Daniel Hua had possessions seized by Singapore authorities in an attempt to claw back funds for creditors. Let's zoom out to see the bigger picture. The 3AC saga illustrates the vulnerabilities embedded in crypto's rapid expansion between 2020 and 2022. This was a period when record-breaking liquidity, fueled by low interest rates and intense retail interest, met with an ecosystem still developing its risk frameworks. Massive inflows into crypto projects created valuations untethered from fundamentals, and investors like 3AC used leverage as a multiplier. But high correlation among crypto assets meant that when a shock like Terra collapsed, the contagion quickly spread. Unspoken counterparty risks became realized losses, and the mosaic of lending and borrowing turned into a house of cards. Quantifying the losses, estimates suggest that 3AC's liquidation directly contributed to billions lost among lenders and investors. Voyager Digital, for example, reported $650 million in exposed loans to 3AC. Genesis's parent company, Digital Currency Group, revealed a significant share of its losses stemmed from 3AC's default. For retail customers whose loans were backed by tokens, a typical loan-to-value ratio of 50 to 70%, this meant forced liquidations at depressed prices, deepening downward pressure on crypto asset prices. For markets, the crash ignited a wave of skepticism about crypto hedge funds in particular. Data from hedge fund research shows that crypto hedge funds underperformed traditional hedge funds by large margins in 2022, with many shuttering due to insolvency or investor withdrawals after 3AC's failure. The fund's implosion is often cited as a turning point marking the end of the crypto easy money era of 2020-21 and signaling a maturation phase where risk management and governance become critical. So, what lessons can be drawn from the Three Arrows Capital collapse? First, leverage remains the fundamental risk driver. While leverage can boost returns, unchecked leverage amid a market downturn magnifies losses exponentially. 3AC's strategy bet heavily on relentless market growth and bullish momentum, without adequate hedging or contingency. Second, transparency matters. The opaque nature of crypto fund holdings and counterparty relationships meant lenders and investors had limited insight into the true risk exposure of 3AC. This lack of transparency delayed risk detection and amplified systemic risk. Third, regulatory gaps represent vulnerabilities. Without consistent oversight, risky practices can grow unchecked. In traditional finance, hedge funds and banks are subject to capital requirements, stress testing, and disclosure rules intended to limit contagion risk. Crypto's regulatory patchwork allowed 3AC and others to operate in a low supervision model, putting the broader ecosystem at risk. Fourth, interconnectedness means shocks propagate rapidly. 3AC served as a major counterparty to crypto lenders, platforms, and projects. Its failure rippled through multiple markets, forcing creditors to cut back lending and investors to liquidate, creating feedback loops that deepen the sell-off. Lastly, 3AC's story reminds us that innovation and speculation can coexist uneasily. Crypto's promise of decentralization and new financial products attracted immense capital and speculative behavior. But without robust risk controls, this mix can produce boom-bust cycles more volatile than traditional markets. As of mid-2024, the ripple effects of 3AC's collapse are still visible. The crypto lending market remains cautious, with lenders documenting stricter terms and collateral rules. Institutional investment into crypto assets includes higher due diligence and risk assessments. Moreover, regulators across jurisdictions from the SEC in the US, AMF in France, and MAS in Singapore are investigating crypto hedge funds and lending platforms to impose tighter rules. At the same time, new funds and players have stepped in, aiming to combine crypto expertise with responsible leverage and transparent governance. The key question is whether this next generation of firms can avoid the fatal overextensions of 3A. This episode highlights an essential truth in finance. Excessive risk-taking rooted in hubris can be the undoing of even the most powerful players. The mechanics here were almost laughably simple. Massive leverage on volatile correlated assets. When those assets crashed, so did everything built on top. Few stories capture the wild volatility of the crypto market better than the rise and fall of Three Arrows Capital. It was a $10 billion gamble that reminded the world that financial innovation must be underpinned by prudent risk management. As cryptocurrencies strive for maturity and broader adoption, the market's memory of 3AC's collapse serves as a sharp beacon about the perils of excess and the fragility of the modern digital finance ecosystem. If you found this story interesting, hit that like button and subscribe so we can keep making these videos. Tomorrow, we are diving into a story that is just as shocking. Greensill Capital, the supply chain finance scandal that hit Credit Suisse. You will not want to miss it. I will see you there.